Hey everyone, and welcome back to the Growth Playbook. Let me ask you a quick question. Have you ever been in a conversation about money, maybe with a financial advisor or even just a friend, and they start throwing around terms like liquidity, APR, or diversification, and you just find yourself nodding along, pretending you know exactly what they're talking about? Yeah, we've all been there. It feels like you need a secret decoder ring just to manage your own money. But what if I told you that in the next 10 minutes, you could master the essential language of finance? What if you could walk into any financial conversation with confidence? Well, that's exactly what we're going to do today. We're breaking down the 10 financial terms every single person should know to build wealth and secure their future. So grab a notepad and let's get started. Term number 1, net worth. All right, kicking things off with the big one, net worth. Think of your net worth as your financial report card. It's the single most important number to understand where you currently stand. The calculation is actually super simple. It's everything you own minus everything you owe. The things you own are your assets. We'll get to those in a second. The things you owe are your liabilities. So if your assets are worth $150,000 and your liabilities are $50,000, your net worth is a cool $100,000. This number is your personal financial snapshot. Tracking it over time is the best way to see if you're making progress. Term number 2 and number 3, assets and liabilities. You can't understand net worth without knowing these two. An asset is anything you own that has monetary value. This includes cash in your bank account, your retirement fund, investments like stocks, the value of your car, or even your home. Assets put money in your pocket or could be sold for cash. A liability, on the other hand, is any debt you owe to someone else. This includes your student loans, credit card debt, a car loan, or your mortgage. Liabilities take money out of your pocket. The goal is simple: increase your assets and decrease your liabilities. Do that, and your net worth will soar. Term number 4, inflation. Okay, let's talk about the silent wealth killer, inflation. In the simplest terms, inflation is the rate at which the cost of goods and services increases over time, which reduces the purchasing power of your money. That $20 bill in your wallet today will buy you less stuff 5 years from now than it does right now. Why does this matter? Because if your money is just sitting in a low-interest savings account, it's actually losing value every single year due to inflation. This is why it's so crucial to save and invest your money, so it can grow at a rate that's higher than inflation. Term number 5, interest rate and APR. This one is a 2-for-1. You see interest rate everywhere. When you save, it's the percentage you earn on your money. When you borrow, it's the percentage you pay for the loan. Simple enough, right? But then you see this other term, APR, or annual percentage rate. Think of APR as the all-inclusive price tag of a loan. It includes not just the interest rate, but also other fees and costs associated with borrowing. So, when you're comparing loans or credit cards, always look at the APR, not just the interest rate, to know the true cost. All right, we're halfway through. I hope you're finding this valuable. Quick question for the comments. Which of these financial terms was the most confusing for you before watching this video? Drop your answer below. I'd love to see what you guys think. Now, on to number 6. Term number 6, compound interest. Albert Einstein supposedly called this the 8th wonder of the world, and for good reason. Compound interest is the interest you earn on your initial principal plus the accumulated interest from previous periods. It's a snowball effect. Your money earns interest, and then that interest starts earning its own interest, and that interest earns interest, and you get the picture. It's how a small, consistent investment can grow into a massive sum over time. The formula looks like this. But don't let the math scare you. Just know that the key ingredients are time and a consistent rate of return. The earlier you start investing, the more powerful the magic of compounding becomes. Term number 7, credit score. Your credit score is a 3-digit number that basically represents your trustworthiness as a borrower. Lenders use it to decide if they'll give you a loan and at what interest rate. A high credit score can save you thousands, even tens of thousands of dollars over your lifetime in lower interest payments. It's calculated based on your payment history, how much debt you have, the length of your credit history, and a few other factors. Paying your bills on time and keeping your credit card balances low are the two most powerful ways to build a great score. Term number 8. Liquidity. This one sounds fancy, but it's really simple. Liquidity refers to how easily you can convert an asset into cash without losing a significant amount of its value. For example, the money in your checking account is very liquid. You can pull it out of an ATM instantly. Stocks are also relatively liquid. Your house, on the other hand, is not very liquid. It could take months to sell it and get the cash. This is why having an emergency fund in a high-yield savings account is so important. That's your liquid cash, ready for you when unexpected expenses pop up. Term number 9. Diversification. You've heard the old saying, don't put all your eggs in one basket. That is diversification in a nutshell. In investing, it means spreading your money across various types of assets, like stocks, bonds, and real estate, and across different industries and geographic locations. Why? Because if one part of your portfolio takes a hit, the others can help balance out the losses. It's the single best way to reduce risk without sacrificing your potential for long-term growth. Term number 10. Budget. And finally, we come to the foundation of it all, the budget. A budget is simply a plan for your money. It's you telling your money where to go, instead of wondering where it went. It tracks your income, money coming in, versus your expenses, money going out. It's not about restricting yourself. It's about empowering yourself. A budget gives you the freedom to spend on the things you truly value while ensuring you're also saving and investing for your future goals. It's the roadmap for your entire financial journey. Bonus point: dollar cost averaging (DCA). Okay, for everyone who stuck with me to the very end, here is your bonus term: dollar cost averaging (DCA). This is a powerful investing strategy where you invest a fixed amount of money at regular intervals, regardless of what the market is doing. For example, investing $100 into an index fund on the first of every single month. When the market is high, your $100 buys fewer shares. But when the market is low, your same $100 buys more shares. Over time, this averages out your purchase price and removes the stress of trying to time the market. It's a disciplined, automated way to build wealth. And there you have it. 11 essential financial terms that are your first step towards becoming the master of your own financial destiny. Understanding this language is not just for Wall Street gurus. It's for everyone who wants to build a better future. If you found this video helpful and learned something new today, do me a huge favor and smash that like button. It really helps the channel out. And for more videos that break down complex money topics into simple, actionable steps, make sure to subscribe and ring that notification bell so you never miss an upload. Share this video with a friend who might need it. Until next time, stay curious and stay financially savvy.